Welcome to the deep dive. We're digging into, well, a really eventful short trading week in the U.S. stock market that was April 14th to 17th, 2025.
Yeah, quite the ride.
Definitely. It was packed with some dramatic swings. And, your goal, as we see it, is to get a clear picture of what went down and why it actually matters without getting lost in the weeds.
Exactly. Keep it focused.
So we're using the weekly market report from Market Deep Dive for that specific week. Our mission, pretty simple, really. Some of the big market moves, figure out what was pushing things around, and see what it meant for different sectors, all in just those few trading days.
Let's jump in. It's fascinating how much action got squeezed into just 4 days. Really shows how sensitive the market is right now.
Okay, so the overall picture. Holiday shortened week, like you said, but definitely no holiday from volatility, huh?
Not at all. The Dow Jones, for instance, closed Thursday the 17th at 39,141. That's down 2.7% for the week.
But it didn't start that way, did it?
No, that's the interesting part. Monday saw a surge up nearly 0.8%, hitting over 40,500. Looked like it might be a strong week.
And
Then the
yeah.
narrative just flipped. Wednesday saw a big drop, about 700 points, down 1.73%, and Thursday followed with another 1.3% loss.
Right. And that puts the Dow down about, 5.5% year to date. The report links that directly to these persistent trade-related pressures.
Yeah, that initial Monday pop seems like maybe some leftover optimism or perhaps just positioning, but those pressures, especially around trade, they just came roaring back and squashed that early hope pretty quickly. Shows how fragile things are.
Okay, and the S&P 500. Similar story, I imagine, though maybe not quite as steep a weekly loss.
Pretty similar, yeah. The S&P 500 closed at 5,283, which was down 1.5% for the week. It also had that Monday gain, almost 0.8%, getting above 5,400.
Before falling hard Wednesday.
Exactly, down 2.24% on Wednesday. It clawed back a tiny bit Thursday, just 0.15%, but it's still sitting, nearly 9% below its peak from back in December.
So broad impact across the big caps there. But the Nasdaq, that's where it gets a bit different. It actually finished the week up. How did that happen?
Right. The Nasdaq Composite managed a 1.2% gain, finishing at 18,258. But it wasn't a smooth ride either.
No.
It was up Monday, too, then got hammered on Wednesday, down about 2.5%, mainly tech weakness.
Ouch.
But then Thursday saw this really strong rebound, up over 1%. That's what saved the week for the Nasdaq.
So some resilience in tech, despite everything.
It seems so. There's still this underlying, maybe bumpy belief in tech's growth potential, even with trade worries, but it's still about 9.2% off its December high, so it's not like it's immune.
And just to get a feel for the fear level, last week the VIX index, it spiked pretty high midweek.
Oh yeah, it touched near 41 midweek. That's high. Real investor anxiety kicking in.
But it didn't stay there.
No, it settled back down to around 30.32 by Thursday's close. So the immediate panic eased a bit, but, 30 is still elevated. The underlying tension didn't just disappear.
Okay, so let's unpack why. What were the big drivers behind this roller coaster? The report really flags tariff policy volatility.
Definitely. It started with that bit of good news, the 90-day pause on tariffs for some tech stuff like smartphones and chips. That gave the market a little boost Monday.
A brief sigh of relief.
Very brief, because then the fear came rushing back. Talk of potentially huge cumulative tariffs on Chinese goods like 145% and China threatening 125% back. That seemed to be the trigger for the Wednesday sell-off.
Wow, those are massive numbers. It really shows how on edge the market is about any trade war escalation.
Absolutely. And the fact that Thursday saw a bit of a recovery, partly on hopes for more exemptions, just underlines it. It's the uncertainty itself that's dragging things down.
Right. And how did the Federal Reserve fit into this?
Well, their commentary midweek didn't exactly help calm nerves. They basically highlighted concerns that these same tariffs could push inflation up and slow down growth.
So adding fuel to the fire. In a way, they kept rates steady, right? Still 4.25% to 4.50%.
They did, rates unchanged. But the market seemed more focused on the Fed's worries about the impact of tariffs.
And what did that do to rate cut expectations?
Pushed them back. The market started pricing in no cuts before June, maybe even later, and expecting less easing overall for 2025, only around 40 basis points. That shift definitely weighed on growth stocks, adding to the pressure Wednesday.
It's such a complicated mix because we also had some really contradictory economic signals, didn't we?
We did. You had surprisingly strong March retail sales, up 1.4%, and car sales jumped over 5%, probably people trying to buy before potential tariffs hit.
So some good news on the consumer front.
Yes, but then you contrast that with the Empire State Manufacturing Index hitting a near record low, minus 8.1, really whack.
Oof.
And consumer sentiment took a dive too, hitting a 32-month low, with inflation expectations ticking up to 5%. That combination really fueled those stagflation fears midweek and made the losses worse.
So good spending in some areas, but overall anxiety growing about the economy. It's a real tug of war.
Exactly. Mixed messages all around, making it tough for the market to find its footing.
Now, the report mentions a technical rebound on Thursday. Can you break that down simply? What does that mean?
Sure. Basically, after sharp drops like we saw Wednesday, stocks can get technically oversold. Think of it like stretching a rubber band too far. It wants to snap back a bit.
Okay.
Indicators suggested the S&P 500 and Nasdaq hit those levels, and when that happens, you often see investors come in looking for bargains, thinking things have fallen too far, too fast. That's the dip buying.
So bargain hunter stepping in.
Kind of. We saw some of that in tech and financials on Thursday, which helped limit the weekly losses. It's more of a short-term market dynamic based on price levels.
Got it. So pulling it all together, how did the different market sectors actually fare through all this? Sounds like quite a mixed bag.
Definitely a mixed bag. Generally, the sectors most sensitive to tariffs and economic jitters, they underperformed. Consumer discretionary, for example, fell 2%. Worries about costs for retailers, auto stocks, tariffs again.
Even with those decent retail sales numbers.
Yeah, the tariff concerns and the weak consumer sentiment seem to outweigh the positive sales data there.
Okay. And what about tech? We mentioned it finished up, but it was volatile.
Right. Tech managed a small gain, about 0.5% for the week. But that was entirely thanks to Thursday's recovery, driven by those hopes for tariff exemptions, especially for chip makers and software.
After getting hit hard midweek.
Exactly. Midweek saw big losses there, especially semiconductors, on worries about export restrictions. So up overall, but a bumpy ride within the sector.
Interesting. Financials seem to hold up relatively well.
They did, yeah. Financials actually rose 1.8%. That was boosted by some strong Q1 earnings from banks, plus maybe some leftover optimism from the March jobs report earlier, showed some resilience.
And then you had the classic defensive plays, utilities, consumer staples.
Textbook defensive buying. Utilities up 1.5%, staples up 1%. When uncertainty spikes, investors often rotate into these sectors seen as safer, less tied to the economic cycle. Safe havens, basically.
Right. But on the other side of the coin, healthcare got hammered, down 4%. What happened there?
Yeah, big drop. We'll touch on a specific stock in a sec, but broadly, it points to sector-specific problems. Things like rising medical costs hitting profits can really cause a sector to underperform, even regardless of the wider market mood.
Okay. And one more small caps. The Russell 2000 actually did better than the large caps.
It did, up almost 1%, about 0.98% to 1,881. It's interesting.
What does that suggest?
Well, it could suggest investors were maybe favoring companies that are more focused domestically, thinking they might be less exposed to all the global trade drama, a shift away from multinational exposure, perhaps?
Fascinating. Okay, let's hit a few specific stocks that made headlines. UnitedHealth Group, UNH. That was a huge drop, down 22%. What's the quick story?
Yeah, massive drop. UNH slashed its profit forecast, blaming rising medical costs. It's a huge company, so it dragged down the whole healthcare sector and had a noticeable impact on the Dow, too.
Wow. And Nvidia, NVDA,
Yeah.
always in the spotlight.
Definitely watch closely. It dropped about 7% midweek. The company took a big charge, like $5.5 billion, tied to those China export restrictions.
Ouch. But it recovered a bit.
It did. It clawed some back on Thursday as those tariff exemption hooks surfaced, ending the week down about 3%. Again, super sensitive to trade news.
And on the positive side, Bank of America, BAC, gained 4%.
Yep. Strong Q1 earnings reported, good loan growth. That optimism from the tariff pause probably helped early in the week, too. Helped lift the whole financial sector.
Then the opposite story for CarMax, KMX, down 17%.
Yeah, big miss on their Q4 profit expectations. They specifically cited higher costs, partly due to tariffs, plus weakening demand for used cars, a direct hit from those pressures.
So it wasn't just stocks bouncing around. What was happening with bonds and commodities? Quick summary.
Sure. Bonds saw more demand, acting as that safe haven, especially Wednesday. The 10-year Treasury yield fell about 17 basis points, from 4.5% down to 4.33%.
Flight to safety.
Exactly, though fears that tariffs might boost inflation probably kept yields from falling even further. Corporate bond spreads widened a bit too, modestly.
And commodities. Gold. Oil.
Gold loved the uncertainty. It surged 4%, hitting a record high around $3,200 an ounce. Classic safety play. It's up like 19% year to date now.
Wow. And oil.
Oil, WTI crude, was up about 1% to around $64.39. It got some support from potential supply worries linked to tariffs, but concerns about softer global demand probably capped the gains.
Okay. And quickly, how did the rest of the world react to the U.S. drama?
Generally, they followed the U.S. lead, especially on the volatility front.
Mhm.
European indexes like the DAX and FTSE were down 1-2%, feeling the pressure from the U.S.-China tensions and worries about maybe the EU getting dragged in.
And Asia.
Mixed. Japan's Nikkei was kind of flat. China's Hang Seng dropped about 1%, directly impacted by the U.S. tariff sentiment. Asian markets generally struggled because they're so reliant on exports, particularly to the U.S.
Emerging markets.
Saw some currency volatility, some modest equity declines, but it wasn't all bad. Some regions actually saw inflows, maybe anticipating some benefits from that 90-day tariff pause.
Okay, so looking ahead then to the week of April 21st to 25th, what were the key things investors needed to watch, just briefly?
Well, number one, any sign of progress or lack thereof in the U.S.-China tariff talks during that pause. That's huge.
Right.
Then Q1 earnings season kicking into high gear, especially the tech giants like Microsoft, Alphabet. How are they talking about tariffs and the economy?
Economic data, too.
Yeah, things like factory orders, consumer confidence, durable goods, watching how those numbers influence sector rotation, and of course, any more signals from the Fed on inflation, growth, and what that means for rates.
So wrapping this up, the big takeaway for you is that the market's recent action really shows this delicate balance, right, between serious anxiety over trade policy and maybe some investors seeing opportunities in beaten-down areas.
Absolutely. It's walking a tightrope.
Yeah.
And without clear policy answers, especially on trade, we should probably expect this kind of volatility to stick around.
Yeah, seems likely. Hopefully this deep dive gave you a good, concise snapshot of how sensitive the market is right now to global events, policy shifts, and those mixed economic signals.
Definitely a lot to track.
And maybe one final thought for you to chew on. Seeing small caps outperform large caps this past week. What might that really be telling us about how investors are feeling about global trade versus maybe focusing more on the domestic U.S. economy? Something to keep in mind as you follow the markets going forward.